We want to bring in Michael Yoshikami right now. He's the CEO and founder of YCMNet Advisors. He oversees $1.1 billion in assets. Michael, good to have you back here with Matt and myself. What do you make of what we've seen in terms of the trade? I mean, we've seen a lot of selling, certainly on the equity side of things. Some say that's a great buying opportunity, like Barton Biggs and a few others, Laszlo Barini. Do you agree?
I do agree. I think it's an opportunity. If you look at the range that the market's been, it's gone below that range just a bit. I mean, our view was maybe it's a 12.2, 12.1 to 12.8 range. But at the point we're at right now, I think stocks are really adequately discounted. You know, I heard you talking earlier about how can the market possibly move forward given how difficult the economy is. You know, the economy is difficult, but it is improving. It's stumbling forward, but it is improving. And I think in that scenario, that's when you add...
Where is it improving? Because there's still a high unemployment rate. Housing numbers are still pretty crappy. I mean, where is it improving?
So here's where the improvement happens. First of all, we have exports doing very, very well because of a weak dollar. We have manufacturing activity that has slowed but still has recovered greatly over the last 2 years. Unemployment now seems like it's stabilizing around 9%. We are starting to see some job gains. Housing is still problematic, but that certainly is a problem. Oil prices have fallen from $115 down to maybe $95 a barrel. So I think you have to understand that it's not all going to be positive. It's maybe 3 positive, 2 negative, and it's a stumbling recovery. But I think you cannot overreact when these negative events come out. That's where the opportunity happens.
Hey, Michael, there's a story in The Onion today that says Ben Bernanke went down to his local pub, had a few too many beers, and told everybody how bad the economy really is. Now, of course, it's a parody, but it just illustrates what we're seeing. Continued shock that these economic figures are coming out so weak. More and more people downgrading. We just saw J.P. Morgan say 2% for 2012 instead of 2.5%. Second half expectations are down below 2% already at pretty much every big house on the street. So what makes you, how could you possibly be optimistic given that kind of sinking outlook?
Well, it depends on where you start from. If you started off the year 3-4% GDP and now it's 2%, there's every reason to be negative. We started the year off, Matt, when we were asked what GDP would be, at about 1.8 to 2% for the year. That is growth. That is not a recession. That's growth. And that's why I think if you have a perspective that's more reasoned rather than more euphoric, I think that's where you see opportunity. It's the euphoric folks that are coming back the other direction, I think, that are so disappointed. The shock to me is people are disappointed that it's such a tepid recovery.
Hey, Julie, let's bring you into this because you're kind of looking at what's going on in households at this point and what's kind of the thinking among consumers.
Yeah, we got the ISM services report today, right? And it was very disappointing to investors. This is just one of the pieces of economic data, Carol, that you've been referring to when we talk about the slowing growth that we have seen. So if you look at services spending over the past couple of years, and remember, services spending is 2/3 of the U.S. economy. Here, we're looking at a chart. Michael, I'll explain it to you because I know you're not necessarily looking at it. Services growth has pretty much, when you adjust for inflation, has pretty much remained stagnant. We've seen an increase in acquisitions of durable goods, of non-durable goods, but for services, it's remained stagnant. So when you look at a number like that, economists say that has to really get better for everything to get better. So do you stay away from the services economy in the U.S. as an investor? I mean, that's a pretty big chunk.
Well, I think what you do is you buy services that have more global perspective. You buy the IBMs, the Oracles of the world, companies that actually are selling services outside the United States. You know, our contention is, even though emerging markets have struggled, when you have growth rates that are going to be 3 or 4 times greater than Europe, 3 or 4 times greater than the United States, that's where you need to chase your growth. And if you look at the numbers, the earnings numbers from services companies that have come back over the last month, many were very, very positive. Why? Because of international growth.
Electric, Michael, global growth obviously is the key to that, right? Because they have so many of their revenues coming from international sources.
Right, absolutely.
You know what, guys? I want to just go back to Bill Gross because we did have him on yesterday. We talked about a lot of things, and he talked specifically about the potential for more Fed action, but he also talked about the state of the economy. Michael, because you're optimistic, I want you to, in particular, listen up to this one.
We are at what we call a stall speed, in which corporate profits don't grow, jobs aren't created, and therefore the economy sinks, based on a stall speed concept.
So, it's hard to disagree with Mr. Gross there, Mike. What do you think about his kind of thinking here? being in kind of this stall speed?
You know, you have to really, let's take that and make it a longer paragraph. What stall speed means is instead of growing at 3%, like many have been predicting, maybe we grow at 1.5% to 2%. You know what this is actually described by PIMCO as? This is described as the new normal. So what we have happening right now is the U.S. is going to go in for years a trajectory, in our perspective, of a slower growth economy, but still a growth economy. I don't think stall is really what's going to happen in the United States. Over the next 2-3 years, I don't think the economy is going to grow. Stall implies 0%. I don't think it's going to grow 0%. I do think it's going to grow under historic numbers, and that's how you have to invest based on that assumption.
Let's talk about Qualcomm, Michael. You know, another pick of yours. Technology has been a big pick for even people who do think we're going to see a stall in the U.S. economy. Why is it such a great fighter? I mean, why is that an industry that will weather the storm even if we have such a bad slowdown here?
Well, here's the thing, Matt. If you're buying in a very difficult economy, what you have to do is be selective. You hear this whole stock pickers statement people make all the time. I would make the case it's not only a stock pickers market, it's a sector picker market. And if you look at what's happening in terms of the wireless sector, is anyone out there going to dispute that wireless infrastructure, wireless connectivity is not an incredible growth industry? Qualcomm, particularly with their relationship with Apple, is well positioned to participate in this tailwind industry. And those are the industries you have to look for, tailwind industries that are going to outperform a 1.5% or 2% GDP growth economy.
Hey, you know, Michael, I found it interesting that you wrote a lot about the autos in your latest research. Before I get a question to you, I want to bring Suzanne into it because, Suzanne, you've been kind of looking at what's been going on in the auto sector. We got a bunch of numbers from them yesterday.
That's right, Carol. We got the July sales numbers that were okay. Sales did rise for General Motors, more than expected. Ford, not as much as Wall Street was expecting. But what we're really seeing with the automakers is potentially more challenges ahead. We have the UAW's Bob King talking today, really upping the pressure as they go through those contract negotiations for Ford and General Motors. They really, the UAW and their new labor negotiations, they want a bigger piece of the profits. Now, that sounded like a great idea when General Motors came out of bankruptcy, but that may not be so realistic this time around. Now, General Motors will report earnings tomorrow. We know Ford has been ahead of the game in improving its balance sheet and returning to profitability. They still have a lot of work to do, but with this new wrinkle in the economy, it remains a question now whether or not the auto recovery will in fact pick up from current levels. And Michael, my question to you is, what's the best auto view or best auto stock in your opinion right now in light of what we learned just over the past week?
Well, first of all, the short answer is I think Ford is probably the best bet. I think they have a huge opportunity for international expansion, and they've done very, very well navigating a very difficult environment. Let me tell you the perspective we have on autos. It's really similar to technology. Technology goes through what's called a product replacement cycle. That was heavily delayed, and then technology has participated in the last year when actually that replacement cycle was restarted by companies. It's same exact situation is going to happen in new car sales. If you look at what's happened in used car sales, they're at record prices because people have been delaying buying new cars. Eventually, they will not delay buying new cars. Maybe not this month, but over the course of the next year or two, particularly if oil prices stay high, people are going to look to replace their cars. On top of that, we have growing economic strength around the world where U.S. cars are really considered a premium. In China, for example, there are 30 auto manufacturers that are located in China that all told only have 35% of the auto market. They are importing their cars because it has more cachet. And I think that's going to be a good sign. It's going to provide opportunities for investors on the long term in the auto sector.
Michael Yoshikami, we've got to run. Thank you so much.